Hello everyone. Good evening to all. Welcome in this session. Welcome in the mini marathon of paper ABFM of Module B. So today in this session, we're going to discuss all important topics related to Module B with the help of MCQs and some previous year questions. So approx 25 MCQs are there, and with the help of those MCQs, we're going to revise our concept which we have already studied in our Module B in our paid classes. Okay, so full coverage of module B in one shot. So with the help of through 25 questions. So just at 4 p.m. we have already completed our ABM module C. So those who have not watched that session, those who are not live in that session. So after the end of this session, please go and watch this session also. All right, now let's start with module B, paper ABM. Now, so what is the agenda? What we are going to discuss in this today's session? That is practice of more and more questions, and with those questions we're going to revise our concept. So this is the way how you can download the YouTube class PDF. You have to go in the courses tab, and after clicking you would be able to find all your YouTube class PDF. Okay, after doing see all. Now, so let's start with the first question. So whichever question answer you are giving, do mention the question number before that. So which statement is incorrect about term loans? We know that there are two types of loan. One is a short-term loan and the next is long-term loan. Now, long-term loans are also known as term loans. So you have to find which is incorrect statement among all the four statements. This is a major source of short-term financing. From the word itself, short-term, it means this is a wrong statement. Now, let's read the other three also. The source is different from equity and relatively cheaper. Yes, we know that debt is a cheaper source of finance. Cheaper source of finance. Loan means what? Loan is a kind of debt. So debt is comparatively cheaper to your equity. Now, short-term loans, medium-term loans, and we have long-term loans also. So short-term loans are that is repaid before 1 year, within a year. Medium-term ranges 1 to 5 and long-term ranges 5 to 10. And if you are purchasing any kind of property, if you are investing in any kind of project, that will come under long-term loans. So option A is the correct statement. Why? Because incorrect was asked. Now, next question. If a project X has an ARR, what is ARR? Average rate of return. Now, what kind of cash flow ARR consider? ARR considers profit after tax. Now, if a project X ARR, it is 18%, and the company has targeted that this much my average rate of return would be. My average rate of return would be 15%, but in actual, the company has made how much in project X? That is 18%. Now, what should be the company do under the ARR method? If we are following ARR method, then which option is correct? Because project X is giving you the higher returns, and the company has target that only 15 returns would be there. So if higher returns are coming, it means what? What is the decision type? What is the criteria for ARR? How we take decision in ARR? We select that project whose ARR is high. So higher ARR, we accept that project. This is what we have studied. So higher ARR is what? 18% and the company target is 15%. So we accept the project because ARR is greater than the target ARR. All right. Now, next question. You have to find degree of financial leverage. So what is given? Sales are given to you how much? We know we have seen the income statement. Sales minus variable cost, that is contribution, minus fixed cost, then EBIT comes, minus interest, EBT comes, minus tax, we get our EAT, or we also say PAT, that is PAT. Now, what are your sales? Sales are your 24 lakh. Now, variable cost is 50%. 50% of sales, that is your 12 lakh, is your variable cost. Now, how much is the contribution? 12 lakh is the contribution. Now, After contribution you have to deduct fixed cost, that is 10 lakh is your fixed cost. EBIT comes 2 lakh. Now next we have to deduct interest. Interest is what? 10%. 10% of 10 lakh means what is the 10% of 10 lakh? 1 lakh. So EBT comes 1 lakh. Now next we have what? That is tax. So tax is what? Tax is 50,000. That is 50,000. Now what is the formula of financial leverage? That is EBIT upon EBT. So EBIT is how much? 2 lakh upon 1 lakh. That is 2 times. So option D is the correct answer. Okay. It tells the relationship between EBIT and your EPS. Clear? So if you are making changes in your EPS, what would be the ultimate result? That is degree of financial leverage. Now, next, which statement is incorrect about preference shares? You have to find the incorrect statement. So this is the part of the profit which provides lesser risk as compared to which is taken by the equity. Yes, in preference shareholders, there is less risk to the investors compared to that which is taken in the equity investors. You don't have to, they are not very risky for your company. Now, if equity is a preferred stock, preference share is a common stock. No, it is wrong. Why? Because your equity is known as your common stock. These why? Because these hold the common shares of the company. So that is why equity is said to be a common stock and preferred shares is said to be a preferred stock. So the opposite is given. So this is wrong. The holder gets a preference in case of dividend also, and when the company gets liquidated, then also these preference shareholders they get a preference. See, from the name itself, it is clear enough preference. A kind of preference is given to them. Now, two types of preference is given. One is the dividend, and the second is when the company gets liquidate or wind up, then also they will get the first priority. So this is also correct. Okay. It is a quasi-risk capital because it is not as safe as secured debts which give payment priority. Now, why? Because in preference shareholders, they get the liquidation value. So they also bear a kind of risk. First, all the obligations have to be set. Company will pay off all the obligations, then they will get the dividend to their preference shareholders. So still, preference shareholders, they will never get the first priority before the debt and the loan payment, the interest payment. Okay, so incorrect is what? That is option B is your incorrect. Rest all the statements are correct. Now, which of the following statement is correct? This is from your ABC activity-based costing. So good quality and low prices are generally considered as the criteria for decision. Yes, definitely when we purchase anything from the market, so we also consider that it should be of less quality. Sorry, it should be of less price and more quality. If the product is for mass consumption, the price and demand elasticity is too high. The elasticity of demand is too high when because everyone is going for the same product only. So price and demand elasticity is very high. Relevant cost is not a fixed one-time concept, but a concept given type. Yes, relevant cost is what it is not your one-time cost. This cost will always occur. That is a recurring cost. So all the statements are correct. Now, next statement 1 and statement 2. Two statements are given. NPV. What is net present value? Net present value is finding the present value of all your future cash flows. So it considers time value of money. Yes. NPV, it considers your time value of money. And it also considers your CFAT. Now, project with positive NPV increase the value from yes. If NPV is positive, it means if it is more than 0, So it will give you the value, it will increase the value in your firm. So both the statements are correct, but there is no relation between these two statements. It talks about that it considers time value of money and it increases the value of firm. So both 1 and 2 are correct, but statement 2 is not the correct explanation. Clear? Now next question number 7. You have to calculate the NPV, net present value. So project costing is given 50,000. So initial cost is what? Initial cost is 50,000. And every year the project is generating how much? 20,000, then 15,000, 25,000, and 10,000 over their 4 years. Now we have to calculate NPV when the discounting factor is 10%. Means, see, we know that NPV it considers discounting. Yes, after considering discounting, you have to calculate NPV. Now, what is the discounting rate? 10%. How to calculate discounting? So, 10% means 1 plus 1 upon R. So, 1 upon 1 plus 10%. So, if you will do this, what answer coming? 1 plus 10% is what? That is 1 upon 1.10. Okay, so 1 divided by 1.10, your answer will come of the first year. What is the discounting? 0.909. And in the 0.0909, the amount which is coming on your calculator, you just have to do equal to. If you will do equal to 0.9, 1 divided by 1.10, then it will come 0.826. Again, if you will do equal to, it will come 0.725. Again, equal to, it will come 0.683. We have to find for the for only 4 years. So this is for first year, this is second, this is third, this is fourth. Now 0.909, see 0.826, 0.751, and 0.683. Okay, sorry, 751. 751. Let me cross check this. 0. Yes, it is 751. Yes, correct. Now, so you will do the discounting. So first year discounting is 0.909 into 0.826 into 0.751 into 0.683. Now find the actual cash flow by considering discounting. So 20,000 into 0.909, 18180. See 18180 coming? Yes. Now let's do the other 15,000 into 0.826. It is also coming 12,390. See 12,390. Now the third is 18,775 and 6830. Okay, now if you will sum all these value, you will get how much? That is 56,175. 56,175. Now if you will see what was the initial cost? The initial cost was 50,000, right? And you have received how much? 56,000. It means what? How much more you have received? That is 6175. Now this 6175 is what? It is your NPV and it is positive. So it means we will accept that project. Even if you are doing the discounting and your value comes in positive, so that project is healthy for your company. Any doubt to anyone in this question? This is very, very important. Such type of question will come. So NPV is greater than 0, that is 6175. So we will accept the project. Now, next question number 8. What is the purpose of H in H model? So H model is what? So purpose of H is it talks about the half of the growth period. If I say that the growth period is 20 years, it means what is the H? in H model, that is we will take it as 10 year. If it is 18, we will take it as 9 years. So to represent half of the extraordinary growth period. Now, what is H model? See, what does this H model says? This model says that H model, it is a way to value a company's share price when the company's dividend is high but not as expected to slow down gradually. Now, H model, it assumes that the company's share price is it increases, okay, and when it increases, then it suddenly falls also. When it increases, it suddenly falls also. Now, so for this, we have two-stage model is included over here. Okay, the two-stage model, what it says that it basically tells you about the H model. It is used when a company's dividend, these are not growing at a fixed rate, but instead, first they grow at a very high rate and then slowly they decrease until they become steady forever. So they are growing, then they are growing at a good rate, then suddenly declining, and then they have achieved their stable position. So it is more realistic than traditional two-stage models, which just assume that there is a sudden shift from high growth to steady growth. So this H model also assumes the initial high dividend growth they won't stay constant, but they will reduce gradually. And the period is called what 2H years. That is the half of the number of years this is called. That is why if you are taking 10 years, we will consider it at 5 years. So once the period is over, the dividends they are again expected to grow at a slow, stable rate for forever. And the model it is developed by Fuller and Sia to better value companies whose high growth is temporarily and and it will settle into the normal growth. So this is what we have assumed over here. Okay, done. So that is your H model. So first it will grow at a high initial rate and suddenly it will go down and it will make the position stable. If you will see this image, see this is the growth rate. Okay, it has growth. It has taken the growth. Okay, now after that suddenly it declines, and after declining it maintains the stable growth rate. So that is the extraordinary growth rate. Then the declining is there, and then the stability is there. So that is GA and GN. So GA is high growth and GN is your low growth, or we can say the stable growth. So given by Fuller and Sia, this is two names are very, very important. So first, it see this statement says the H model it is opposed to traditional two-stage model. Now it says that the exceptional growth rate is there in the beginning. So in the beginning, this will grow very fast, then suddenly it will decline, and after that it will achieve the position of the stable growth. So this declining is this is high initial rate and this is stable rate. Clear? So this is your H model. And this is the formula. You have to learn the formula because it is important. So DOP talks about the value of your market stock. Then DO is the dividend of the present year. GA is what? GA is a high growth phase. Okay, the high growth. And GN is what? It is the stable phase. Then rate of dividend is denoted by R, and H is what? That is the half of the E. So formula is important. Now question number 9. Which of the following statements are true? So payback period method considers all cash flows of a project. Is it so? Payback period means what? That once you know what the initial investment which you have made, now how much you are recovering, how much investment you are recovering in your coming years. Like if you have invested 10,000 Now that 10,000, you are recovering this 10,000 in how many days, in how many months. So the less the period is, the more better for your company. So that is why the decision criteria for payback is lower the better. This is the money which you have invested now. After how many days you will return, you will get back this money. That is your payback period. So it considers all cash flows? No. If you are recovering your money in suppose 10,000, 1 month you are getting 2,000, then you are getting 3,000, then you are getting again 1,000, 4,000, then 2,000. Now tell me, will you going to consider the all cash flows? No. You know that in first year you are getting 2,000, 2 plus 3, 5, 5 plus 1, 6, 6 plus 4, 10. Means in this year you have got your all money back. So why you will going to consider this year cash flow also? The payback period method considers all cash flow? No. Payback period method concerns with the recovery. Yes, it is more concerned with the recovery rather than the profitability. And net present value represents net addition to the wealth of shareholder. Yes. Accounting rate of return, it considers time value of money. No, it does not consider. So we have two methods. One is payback period, and the next is accounting rate of return. These two methods are the methods they does not consider time value of money. So B and C are correct. Option B. Clear? Now, next question. What question says? This is not Kuman, this is Kumar. Kumar and Sons has 10 rupees equity share amounting to 15 crore. Okay, rupees 10 equity shares are there, which is amounted to 15 crore. Now, the current market price of the per equity share is rupees 60. So, current market price is what? That is 60 rupees. Prevailing risk-free interest. So, risk-free interest is what? That is 5.5%. Now, market risk premium is what? Market risk premium means RM minus R. This is your market risk premium. The market risk, okay, market factor minus risk-free rate is how much? That is 8%. Now, what is the beta beta is given. Beta is also given. Beta is 1.1875. Now, what you have to find? You have to find the K, the cost of equity. Now, how you will be able to find the cost of equity? So, for this, we have formula, that is cost of equity. This is now this question is from your CAIIB model, that is capital asset pricing model. Okay, CAIIB model. Now, CAIIB model, formula of CAIIB model is, that is cost of equity K is equal to RF plus beta into RM minus RF. Now, what is RF? RF is given 5.5% plus beta is 1.1875. RM minus RF is given market risk premium, that is 8%. So 5.5% plus what we have 1.1875. That is 9.5%. So 9.5 plus 5, 15. So what is your answer? That is 15% is your answer. Understood how to calculate the cost of equity with the help of CAIIB model? The cost of equity is also calculated with the help of Gordon formula also. D1 upon TO plus G. Remember? This is with the help of Gordon formula. Now, I hope this is clear to you. And see, this is the explanation. Okay, risk-free interest rate is 5.5%. Then you have market risk premium and beta is given. Simply you have to apply in this particular formula. Now, next is question number 11. So, net present value rule, what it states, what this rule states, net present value. An investment should be accepted if and only if the NPV is exactly equal to zero. No, you are indifferent over here. Why indifferent? You know that you have invested 10 rupees in the project. Now you are getting same 10 rupees in as return. So it entirely depends on you whether you want to invest it or you want to reject it, because no increment you are getting, no returns you are getting only the same return which you have expended. Okay. Now we will not consider this. An investment should be rejected if NPV is positive. How when your NPV is positive, you have to accept that project. And when your NPV is negative, you have to reject that project. This is also wrong. And NP investment should be accepted if NPV is positive and rejected if it is negative. Yes, this is correct. If your NPV is positive, you have to accept that project. Now, which statistical measure is central to the Hillier model for comparing projects? So Hillier model, it is one of the method to analyze the risk which is associated to your project. So it takes consideration the standard deviation. For measuring the risk, standard deviation takes the base standard deviation. So Hillier model, again, it is the method used by investors to analyze the risk which is involved in your decisions. And like all other methods, we have simulation analysis, sensitivity scenarios, all other methods. This method also makes a base NPV. Now, the important who created this, he also believed that the risk in cash flows, it can be measured using standard deviation. So Professor Frederick S. Hillier has said that the risk is associated with your cash flows and you have to analyze those risks. If your cash flows are very much fluctuating, then it means that project is unhealthy for your company. If your cash flows are not that much fluctuating, low deviation is there, so low risk will also be there. If cash inflows don't change much, there is less risk. Like, okay, you have invested 50,000. Now, first year you are getting 10,000. Second year you are getting 1,000. Third year you are getting 12,000. Then you are getting 200. Then you are getting 17,000. Then you are getting 250. So if you will see that the cash flows are varying too much. If the cash flows are varying too much, it means high deviation is there. The deviation is very high. Okay, 9,000 deviation is there. Then 11,000 deviation is there. So it means it is of high risk. And if your cash flows are like you have invested 50,000, you are getting 10,000, you are getting 12,000, then you are getting 11,000, then 13,000. So it means the cash flows are even type of cash flows. So they are not fluctuating. It means there is less risk. Now, question number 13. Different types of share capital are given. So paid up share capital is what? It is the capital. This capital is the amount of money a company has received from its shareholders in exchange of shares. Forfeited shares are when company has called you for the shares, you have not paid up, you have not done the payment of all the shares. Now what company can do? Company can buy back those shares. So means they can forfeit their shares back. So forfeited is part of the subscribed capital which is not fully paid, and finally the company forfeits something. Authorized capital is your registered capital, your nominal capital that the company has been authorized to issue in the whole life of the company. So it represents the maximum amount of capital that company is authorized to issue, and subscribed capital portion of issue that the public have subscribed to issue. All right. Now, so it is 3, then 4, 1, 2. So option A is the correct answer. Now, question number 14. If a firm has high operating leverage, then Means operating leverages OL is high. OL means what? It includes your business risk. Okay, the fixed operating cost. So OL is high. It means if you are making a small change in EBIT, it will lead a small change in sales. It will lead to a large change in your EBIT. So if your sales are changing at 10%, might be your EBIT will change by 20%, 30%. So that is the option. The answer is option number A. Clear? A small change in sales, it will lead to a large change in EBIT. And a small change in EBIT leads to a small change in EPS. What it means? It includes your financial leverage. That if we make a small change in EBIT, okay, it will lead to a large change in EPS. Okay, done? Wait. Yes. Now, so this is how a example is given. Okay, suppose a company is making shoes now. For making that shoes, fixed cost is 1 lakh. Now your fixed cost will always be, it will remain same. Why? Even if you're not doing the production, you have to pay the rent of your factory, you have to pay salaries to your employees. So it is not changing, it is always fixed. So 1 lakh. Now variable cost is rupees 200 per shoe. Means for making one shoe, you have you have to pay 200 variable cost. And how much you are making the how what is the sale price of your shoe? That is 300. Suppose you have done the sales of 1500 shoes. Now 1500 into 3, these are your revenues. 3 lakh is your variable cost. And what comes contribution? 1 lakh 50,000. And in that 1 lakh 50,000, you have to cover your fixed cost also. So ultimate the EBIT, the operating profit is 50,000. Suppose you have increased your sales by 10%. 10% means 15,000, 1500 means 1500 plus 150, that is 1650. Now, if you have changed your sales by 10%, then ultimately your EBIT would be 65. So now EBIT is changed to how much? 50,000 to 65,000. 15,000 extra means 30%. So you can see that if you are changing 10%, if you are bringing changes in sales by 10%, your profit is also you're changing to 30%. Means 3x. Three times the profits are changing. Clear? So this is how the if you are bringing small change in sales, your EBIT will change. There will be the big impact in your EBIT. So that is what? That is the high operating leverage. Clear? Now, next we have question this. Okay, a company is evaluating two mutually exclusive projects, Project X and Y, and their initial investment is 50,000. So initial, how much the company has initially invested? 50,000. And in first year, the company's Project X is receiving 10,000, 15,000, 20, 25, 30. And Project Y is 20,000, 15,000, 10,000, 10,000, 10,000. Now you have to find the payback period of Project X and Project Y. So how you will going to find the payback? So for finding the payback period, we know that if your cash flows are even, then you have to apply simple formula. But if your cash flows are uneven, what are these? These are uneven cash flows. So what you will do in this case, you will find the cumulative cash flows. Now cumulative cash flows means what? That you have to add. Okay, first year you are getting 10,000, then 10 plus 15, 25,000. 45,000, 70,000, and 30,000, that is 1 lakh. Clear? Now here also cumulative cash flow you will find 20,000 in first year you are getting, then 35,000, then 45,000, then 55,000, and then 65,000. Okay, so this is your cumulative cash flows. Now, after this, what the question is asking, what is the payback period of project X? So we know that payback period means you have invested 50 rupees now. In how many years you are recovering your 50 rupees? So you can see that in third year and in fourth year. So in between third and fourth year, you will receive your money. So third year is fixed plus how much extra you have to receive 45,000 is there. You have to receive 50,000 means 5,000 more extra plus and total amount is given in fourth year. You are receiving total how much? Wait. Okay. The total amount you are receiving that is 25,000. Okay. 25,000. So 3 years are fixed plus 5,000 upon 25,000. What is the answer coming? 5,000 divided by 25,000. That is 0.2. It means 3 plus 0.2 means 3.2 years, means 3 years and 2 months. This is the payback period of project X, 3.2 years. Now simply you will find the payback period of Y also. How much? 45 and 55. Now we know that in between 3 and 4th year you will receive your money. How many months you will extra need for this? Again 45,000 is there. So we need how much extra? 5,000. And total is what? 10,000. So 5 divided by 10, that is 0.5. So 3.5. So in 3.5 years, the payback period of project Y is 3.5 years. Now, if I ask you the question that which project you will going to choose, project X or project Y, so what would be your answer? That is 3.2 because we know the criteria that is lower the better. The project which is helping you to recover in less period of time your money back, that is the project that is good project for you. So this is how you can calculate. I have added the explanation also. Okay, so which project you will prefer? Project Y because it gives uniform cash inflow? No. Both are equal? No. Project X? Yes. Why? Because it has a shorter payback period. Okay. Now, which of the following it is a limitation of payback period? So what is the drawback of payback period? We know that payback period, it does not consider time value of money. So it considers time value of money. That is the limitation. Clear? It ignores risk element. It ignores cash inflows after the payback. It considers time value of money. No, it does not consider time value of money. Now, question number 19. What does this question say? Now, this question, it is based on your arbitrage pricing theory, EPT. Now, arbitrage pricing theory, what it says that the people, the individual, the investors, they make profit from price differences. Now, what is this price differences? Suppose, suppose in any market, the value of share is one share is costing rupees 10. Okay, in one market, and in another market the cost of one share is rupees 12, not 20, rupees 12. It means what? You are getting 2 rupees extra in other market. So what you will do, you will buy the shares in bulk, okay, from this market, and you will sell the shares in the market where the price is high, and this you will do simultaneously, means no gap is should be there. Like right now you have purchased and right now you have sold in other market. So you are making the profit of 2 rupees. Suppose you have purchased the 100 shares. Now, At 1000 you are selling and you are 1000 you are purchasing and you are selling at the rate of 1200. So this 200 is what? It is your profit. So that is called arbitrage. Okay. From price differences, the investors they make profit. That is arbitrage. Now, question is given. You have to find the expected return for an international project. A multinational company is evaluating an overseas infrastructure project, and the project returns are like this. For every project, the risk premium is given. Like we know that beta is what? Beta is the risk of the company. Now it's for GDP growth. What is the risk? 1.1. And for covering that risk premium is given 3%. Now foreign exchange rate volatility, beta is how much? 0.7. And for covering this beta, this risk, the risk premium is given 2%. Now, for commodity price changes, risk is minus 0.4. See, minus is there. And risk premium is given 1.5%. Now, and without facing any kind of risk, how much you can earn? 4%. So, with the help of this, you have to find the expected return. Now, how to find? First, without facing any kind of risk, how much you can earn? 4%. Now, for GDP, what was the risk? 1.1. And to cover risk, this risk premium is given. So beta into risk premium plus beta 2 into risk premium 2 plus beta 3 into risk premium 3. If you will calculate, you will be getting 8.1% as your expected return. So this is the return which you are expecting from that market where the price differences are very high. Okay, yes, I guess everything is good. I thought my voice is not coming. Now, clear? Done? Now, question number 20. So we have 3, 4, 5 questions more. Yes, 5 questions, 6 questions are there. Now, statement 1. GDR are issued in the US market while ADR issued in a multiple market? No, it is entirely wrong. GDR are issued in multiple international markets while ADR are issued in US market. Now both ADR and GDR they represent ownership in shares. Yes, the statement is correct. So statement 1 is wrong and statement 2 is true. Now next question number 21. So 4 types of risk are there. Now, what is liquidity risk? When you don't have sufficient assets to convert it into cash. Inability, you have liquid assets, but they are not easily convertible into cash. That is liquidity risk. Credit risk, when the borrower pay default on obligation, when borrower fails to pay you the money when the due date comes. Market risk is from market fluctuation, and operational risk is from failed process. So A4, B3, 4, 3, 2, 1. Option C. Now, next question number 22. 4 statements are given. Risk adjusted discount rate. It is a method where higher risk projects are discounted at higher rate. Yes. Now, why risk adjusted is given? So that you can adjust the discounting rate according to the risk. If the project is having more risk, you will do the discounting at more high rates. If the project risk is come, you will do the discounting at less rates. Certainty equivalent measures method replace risky flows. Yes. What is certainty equivalent? Certainty equivalent is it is what when you are 100% sure that you will get return from this project. Like you have invested in project A and you are 100% sure that even if this project is more risky project, still you can make the returns of 4%. That is 100% confirmed. So it replaces the risky cash flows. Yes. Sensitivity analysis examines the impact of changes in one variable at one time. Yes. Sensitivity analysis, we change one variable at a time and we see the effect on all other variables. This is also correct. All capital budgeting techniques, they ignore risk and uncertainty. No, not all capital budgeting. They include some risk also and they check the uncertainties as well. So 1, 2, and 3 are correct. Option D. Okay. So in this, not everything is ignored. So statement 4 is incorrect. Several techniques they address risk and uncertainty. Now, two statements are given. You have to find which statement is true and wrong. So what statement first it says risk analysis gives management better information about the possible outcomes. Yes, when any investor is investing on any project and before investing, investor has analyzed all the risk. They have checked all the risk. They have mitigated all the risk. So that after that it will help the investor to make informed decision related to their project so that they can do the judgment and they can get a good experience whether to accept that project or to reject that project. Yes, this statement is 100% true. Now, in relation to capital budgeting, simulation analysis deals with the consideration of the sensitivity to the NPV. Okay, see, we know that all method they have used base their NPV, but in simulation analysis, we don't change one variable. We change multiple variables and then we see the impact. So, but in which analysis we change one variable, sensitivity of the NPV, and we see the impact on different variables. That is the sensitivity analysis. So, in sensitivity analysis, we change one variable and we see the impact on all other variables. So, statement 2 is false and 1 is true. Clear? So second statement, it is wrong. Now, question number 24, statement 1 and 2 are given. So in international projects, they face transfer risk. Yes, transfer risk means when you are transferring any project from one country to another, any product or services, you have to face transfer risk. Why? Because profit repatriation is involved in it. Now, what is profit repatriation? So it is sending profits earned by a company from one from one country to another country. Like you have earned profits in any foreign country and you are sending back your profits to your home country. So in that, the company they have to face many different challenges. Okay. So Indian company has set a subsidiary in USA. Now subsidiary has earned 50 crore profits in USA. Now, when the company is sending back that 50 crore, it is called profit repatriation. And in doing profit repatriation, different risks also arise. Like sometimes the taxes are there, okay, the double taxes are charged, and to avoid this double taxation, one agreement both countries have to sign the agreement that is called double taxation avoidance agreement. So foreign exchange regulations are there that will also create the problems in profit repatriation. So yes, this is correct. Okay, understood. Now, transfer risk refers to the possibility of restrictions on transferring funds. Yes. So transfer risk, it refers to the restrictions when you are transferring your profit from foreign country to your home country. Now, both the statements are correct. And if you will add because, okay, if you will relate these two statements, so they are related also. So international projects face transfer risk when they involve profit repatriation because transfer risk refers to the possibility of restriction. So both the statements are true and statement true is the correct explanation. Now, last question, three statements are given. So social cost benefit analysis, this is also one of the analysis done. And what it says that when you are investing on any project, you have to ensure that that project is not creating the harmful impact to your society, to the environment, to the sustainability. So that is social cost benefits. It evaluates desirability of the project by comparing cost, benefit. Yes, it is only relevant for private sector. Is it so? No, it is related for all other sector, not only private sector. And the use of shadow prices in SCBA help account for this. See, we know that the market price they don't always reflect the true value. So in the real world, prices in the market they may be distorted because of taxes, the subsidies, the monopolies. So just looking at market price, it can give you the wrong picture and it will not going to benefit to the society. So shadow price, it is an estimated true value of goods and service to the society, even if the market is not showing the actual value. So it is used in social cost benefit analysis to correct all these distortions. So social cost benefit analysis tries to see whether a project is good for society as a whole, not just only for private profit. So it uses shadow prices instead of actual market prices to capture the real cost and benefit related to this. So this statement is also correct. So 1 and 3 are correct and 2 is wrong. Yes. Okay, so we have done 25 questions so far. Any doubt to anyone in any of these questions? Please ask me if you have any doubt. And if you feel that sessions are helpful to you, please like the session and share it with others as well so that more and more bankers they may get the benefit of solving these questions. All are important questions. Not the question, but also the topics are very important. So you will not going to get the same question in the exam, but the topic which you have done the question, that topic will definitely come. Now, so this is your super elite all in one plan. If you have not yet subscribed to this plan, I highly request you to please purchase this plan. Please enroll in this plan so to get all these benefits. And moreover, if you feel sessions are helpful to you, you can like the session, share it with others as well. Subscribe the channel if you have not done yet. That is CAIIB English Medium. And this is your bilingual channel. Okay, chalo. So let's meet you in another session. So today we have done two sessions, the ABM module C of ABM and right now module B of ABFM. So I hope please the PDF will be uploaded. So do revise these questions again and all the numerical question as well. So all are important. Okay, chalo. So let's meet you in another session. Till then, take care everyone. Goodbye. Keep studying, keep watching.